Welcome to Griffonomics.
It is great to be back, even if the circumstances we're talking about today are pretty brutal.
Yeah, brutal is definitely the word. So, on Tuesday, Badger Meter was essentially this 120-year-old Wall Street darling.
Right.
I mean, it was trading at a massive premium, like 40 times earnings. People hailed it as this ultimate transition story, moving from a mechanical metal bender to a high-margin smart water tech provider.
Exactly. A total golden child of the industrial sector.
Right. But then by Wednesday afternoon, a full quarter of its market capitalization was just wiped out.
Gone. Just evaporated.
Yeah. It was the steepest intraday plunge the stock has seen since the 2008 financial crisis.
Which is insane to think about.
It really is. So if you're listening to this and looking at your portfolio right now, you're probably asking yourself how a company with zero debt and, well, a virtual monopoly on certain municipal contracts just loses that much value between lunch and market close.
Yeah, it really forces a total reevaluation of the investment thesis. I mean, when a premium-priced industrial technology firm drops 24% in a single session, you aren't just looking at a bad quarter.
No, definitely not.
The market is basically pricing in a structural break in their entire growth narrative. The valuation multiple essentially compressed in real time.
Which brings us to the mission briefing for this deep dive. We are generating a highly granular strategic report and an investment roadmap dissecting Badger Meter's Q1 2026 earnings shock. Ticker symbol BMI.
Right. We've got a lot of ground to cover.
We do. We are going to tear down the balance sheet and the income statement to find out exactly what happened with this double miss. We'll unpack a massive $100 million M&A pivot to the UK, dissect a pretty wild geopolitical supply chain crisis threatening their gross margins, and ultimately map out whether their proposed second-half recovery is a solid reality or just a massive value trap.
Yeah, and we really need to start with the forensic details of the earnings miss.
Let's do it.
Because, the raw numbers paint a very specific picture of negative operating leverage. So total sales hit $202.3 million.
Right.
That is a 9% year-over-year decline. And it missed Wall Street estimates by nearly $29 million.
Wow. And when you actually break down that top line, the weakness was incredibly broad. Like, utility water sales dropped 10%.
Yeah.
And their flow instrumentation slipped 4%.
Right, so it wasn't just isolated to one specific product line.
Exactly. Yeah. But the bottom line is where the real damage became apparent. Diluted earnings per share came in at 93 cents, which missed the consensus by 26 cents.
And that EPS miss, it wasn't just a byproduct of the lower sales volume. It was the result of their cost structure essentially turning against them.
Which is that negative operating leverage you mentioned.
Exactly. So in high-tech industrial manufacturing, operating leverage is your best friend on the way up, right?
Correct.
Your fixed overhead, things like engineering, administrative costs, software development, that all stays relatively flat while your sales volume expands. So the margins just widen beautifully.
But in Q1, Badger Meter experienced the exact inverse of that.
They did. Sales dropped 9%, but their selling, engineering, and administration expenses, the SE line item, it actually rose by $3.1 million.
Hitting $49.2 million.
Yep, $49.2 million.
Because, you can't just turn off your engineering and software development costs overnight when orders slow down.
No, you really can't. You have people on payroll, you have active R&D.
Especially not when a significant portion of those rising SEA expenses were tied to recent strategic moves. They had an extra month of expenses from their recent SmartCover acquisition baked into the quarter.
Right.
Plus $1.2 million in transaction costs for the UDlive deal, which we'll definitely discuss later. So you basically have a contracting top line colliding with an expanding fixed cost base.
And the mathematical output of that collision was just brutal. Their operating margins contracted from a record 22.2% in Q1 of 2025 all the way down to 17.4%.
Ouch.
Yeah. That is a massive squeeze for a company that the market priced for absolute perfection.
Now, management obviously anticipated the market's reaction. CEO Ken Bockhorst and his team aggressively pushed what they're calling the pacing gap or the air pocket theory.
Right, the famous air pocket defense.
Yeah. They're arguing that this 9% revenue drop does not reflect a change in underlying demand or, a loss of market share. They are pointing to a massive backlog normalization dynamic instead.
So to understand their argument here, you really have to look at the deployment logistics of advanced metering infrastructure, or AMI.
Right, the smart meters.
Exactly. Between 2023 and 2025, Badger Meter recognized revenue on a massive overlapping cohort of AMI projects totaling about 800,000 connections.
Which is a huge number for them.
Massive. These are multi-year technological rollouts for large municipalities. And because so many of these projects were happening simultaneously, it created this artificially smooth, elevated revenue curve.
Basically masking the inherent lumpiness of municipal procurement cycles.
Exactly. They were essentially operating way above their normalized trend line for 2 years.
But entering 2026, that specific 800,000 connection cohort largely wrapped up, the backlog normalized. And the next waves of awarded projects simply hasn't reached the heavy deployment phase yet.
Right.
So management's defense is that Q1 just happened to fall into the dead space between the old mega projects finishing and the new mega projects starting. It's like a relay race where the first runner finishes before the second runner is even ready to grab the baton.
It's a compelling operational narrative, honestly. The timing of municipal deployment is rarely linear.
Yeah, I'm sure.
You have permitting, you have environmental reviews, contractor scheduling, all of which creates these natural revenue air pockets.
I understand the mechanics of the pacing gap. I really do. But I have to push back on management's visibility here.
Okay, let's hear it.
If they knew this deployment gap was coming, like if they knew the 2023 cohort was winding down and the 2026 cohort wasn't ready to ramp, why did this catch the institutional analysts so completely off guard?
That is the million-dollar question.
Right, like is the pacing gap a genuine operational reality, or is it just a convenient post-mortem excuse for losing momentum?
Well, management claims they attempted to signal this. On the previous earnings calls, they noted that 2026 revenues would be heavily back-half weighted due to project pacing.
But clearly, the guidance wasn't stark enough for Wall Street.
Not at all, because when a company is trading at 40 times earnings, the market models in uninterrupted secular growth.
Right.
A sudden return to lumpy revenue realization shatters that whole mathematical model. The market violently punished the stock because, in the short term, an air pocket is statistically indistinguishable from a structural decline in demand.
And that brings us to the most concerning data point from the entire Q1 report, I think.
The short cycle business.
Yes. Because if the pacing gap only applied to these massive multi-year AMI projects, the market might have eventually forgiven them. But the weakness bled into their baseline business. We need to talk about the short cycle shock.
This is the core of the bear thesis right here. Alongside the project delays, Badger Meter reported an unexpected $15 million to $20 million shortfall in their standard short cycle municipal orders.
To put that in context for you, short cycle orders are the everyday run rate business.
Right.
These are the standard replacement meters and basic components that municipalities order continuously through regional distributors.
Yeah.
It is not tied to multi-million-dollar citywide tech upgrades.
No, it's just the baseline operational demand, keeping the lights on, keeping the water flowing.
Exactly. So a $20 million hole in that specific revenue stream suggests something much darker than a project pacing gap.
It suggests fundamental budget fatigue at the municipal level. If we look at the macroeconomic environment, local governments have been heavily insulated over the past few years by the American Rescue Plan Act, ARPA.
The COVID stimulus money.
Right. That federal stimulus injected billions into local water and infrastructure budgets. But those funds are now expiring or have already been fully allocated.
And you have to combine the expiration of ARPA with the current yield curve on municipal bonds.
Exactly. Money is not cheap anymore.
Right. Borrowing costs for local governments are significantly higher than they were 3 years ago. So municipalities are looking at their capital budgets, realizing the free federal money is gone and debt is expensive, and they are actively restricting their procurement.
They are essentially extending the replacement cycles on their existing hardware to save cash.
Which hits Badger Meter directly.
That is the exact mechanism the bears are pointing to. But, and this is important, management vehemently denies that this is a structural issue.
Right. Bockhorst insisted on the earnings call that they are in constant contact with their distributor network.
And they say they are simply not hearing that municipalities are permanently constraining budgets. Management's official stance is that this short-cycle weakness is also just a timing issue.
A bizarre coincidence where the short-cycle orders paused at the exact same moment the massive AMI projects paused.
That's what they're going with, yeah.
But that narrative contains a massive, glaring contradiction in my eyes.
The guidance cut.
Yes. If management truly believes this is just a temporary coincidental pause in short-cycle orders, why did they drastically cut their forward guidance?
Right. They revised their full year 2026 organic revenue guidance down from growth to relatively flat compared to 2025.
You don't cut full-year guidance to flat if you genuinely believe those everyday distributor orders are just delayed by a few weeks.
No, you don't. And you're highlighting the exact credibility gap that triggered the 24% sell-off. The guidance cut fundamentally undermined the temporary air pocket defense.
It really did.
It signaled to institutional investors that management lacks visibility into when, or even if, these municipalities will actually open their wallets again. It basically mutated a disappointing quarter into a long-term structural fear.
So we have a top line that is cracking under the weight of delayed projects and tightening municipal budgets. But while analysts were hyper-focused on the revenue miss, there was a massive, high-stakes defensive war being waged on the balance sheet.
Yeah, the raw materials situation?
Exactly. It's tied directly to geopolitical tensions. It's a fascinating look at the fragility of the global supply chain, specifically concerning a metal called bismuth.
Yeah, bismuth is a metal most people have probably never thought about.
Never.
But it is the absolute linchpin of Badger Meter's regulatory compliance in the United States.
How so?
Under the Safe Drinking Water Act, potable water systems are mandated to use lead-free brass components.
Right. No lead in the drinking water. Makes sense.
Yeah. Exactly. But to manufacture brass that meets that lead-free mandate while still retaining the necessary metallurgical properties for high-pressure water meters, you have to alloy it with something. Specifically, you need the machinability and pressure tightness. And to get that, you have to use bismuth.
It is a non-negotiable raw material. Without it, they cannot legally sell their core products in the U.S. market.
Exactly. And the geopolitical reality of bismuth is terrifying from a supply chain perspective. China currently controls approximately 88% of global bismuth production.
Wow.
Yeah, it is a functional, unassailable monopoly.
And in February of 2026, that monopoly was weaponized?
It was. In direct retaliation against broader U.S. import tariffs, China implemented strict export controls on bismuth. They essentially choked the global supply overnight.
And the pricing reaction was violent, to put it mildly. Bismuth went from a baseline of about $6 a pound a year prior to an all-time high of roughly $34 a pound by March of 2026.
A near 600% price spike on a mandatory raw material.
It should have completely obliterated Badger Meter's gross margins in Q1. I mean, destroyed them.
It really should have. But it didn't. And this is where you really have to give their procurement and treasury teams immense credit.
Oh, absolutely. They saw the geopolitical chessboard moving, and they executed a massive proactive inventory pre-buy.
Right. If you examine the cash flow statement, you'll see an inventory surge of over $23 million in the first quarter.
So they essentially aggressively went to the open market and bought as much low-cost bismuth as they could warehouse before the export controls fully locked up the pricing.
Yeah, like a squirrel frantically hoarding nuts right before a historically brutal winter hits.
That's a perfect analogy. It was a brilliant tactical maneuver. They built their own strategic reserve, and by hoarding that lower-cost material, they successfully insulated their manufacturing costs for the quarter.
It's why their gross margins actually held incredibly strong at 41.7%, which is right near the top of their historical and normalized range.
It protected the quarter, for sure. But from an accounting and valuation perspective, it introduces a massive structural risk.
The cost lag hangover.
Exactly. That $23 million inventory cushion is finite.
Very finite.
Because they utilize specific inventory accounting methods, eventually those low-cost raw materials will be fully depleted from the warehouse and recognized on the income statement.
Right. They are still legally required to manufacture lead-free brass. So what happens in late 2026 when the strategic reserve runs dry?
They will be forced to start procuring bismuth at the new, artificially inflated $34 a pound rate.
And that higher cost of goods sold will immediately start compressing their gross margins. The real danger here is the timing.
Right, because that margin compression curve is projected to hit the income statement at the exact moment the company is supposedly relying on its massive second-half revenue ramp-up.
Exactly. You could have a scenario where revenues finally recover, but the profitability of those new sales is completely crushed by the bismuth cost lag.
Management was pushed on this during the Q&A, right? Analysts essentially asked, can't you just reshore this or source it from allied nations?
Yeah, and management was remarkably candid about it. They are aggressively evaluating alternative sourcing from Vietnam and Japan.
Right.
But when a single nation controls 88% of global capacity, completely extracting yourself from the Chinese supply chain in the short term is just an illusion. It's nearly impossible.
They do have some geographic insulation on the manufacturing side, though.
They do. A significant portion of their assembly happens at their Nogales facility down in Mexico.
Right. And under the rules of origin within the USMCA trade agreement, the electronic equipment and components moving across that specific border are protected from broader Section 232 tariffs.
Yeah, which absolutely protects their labor and assembly costs. But the USMCA doesn't magically create bismuth mines in North America,
No, it doesn't.
The raw material constraint remains their absolute Achilles heel.
Okay, so if you are keeping score at home, Badger Meter is facing a municipal budget freeze, a massive gap in project deployments, and a looming 600% raw material cost hangover.
It's a rough hand to play.
In that scenario, conventional corporate finance dictates that you assume the crash position. You cut discretionary spending, hoard your remaining cash, and wait for the macro environment to stabilize.
The standard playbook, yes.
But Badger Meter did the exact opposite. On the very same day they announced this double mess, they deployed $100 million in cash to go on the offensive.
Yeah, the UDlive acquisition, it was the major strategic curveball of the earnings release.
Let's talk about the mechanics of this deal because it is wild.
They announced a definitive agreement to acquire UDlive for $100 million, funded entirely from their existing cash reserves.
Which represents a massive pivot in their global strategy. UDlive is a UK-based provider of hardware-enabled software, specifically focused on sewer line and stormwater monitoring.
And their dominance in the United Kingdom is just staggering. They were founded in 2017, but they have already captured a 60% market share in the UK.
In less than a decade.
Yeah, and the competitive moat they've built is incredibly deep. They currently boast a 90% success rate when competing for utility tenders.
90%? That's almost unheard of.
It is. From a financial profile, they generate $22 million in trailing 12-month revenue. They are already operating at a positive profit margin, and their gross margins are highly accretive to Badger Meter's consolidated profile.
But to understand why they have a 90% win rate, you have to look at the technology itself. They aren't just selling simple float sensors.
No, they utilize low-power, long-range radar sensors installed underneath manhole covers.
Which is a huge upgrade over older tech, right?
Massive. Unlike older ultrasonic sensors that can be easily fouled by debris or condensation or cobwebs, these radar units provide highly accurate, continuous 247 monitoring of water levels in extreme subterranean environments.
But the hardware is only half the equation here.
The real value is the proprietary analytics and visualization software that processes that continuous radar data. It allows utilities to transition from a reactive posture, sending a crew out after a sewer has already overflowed, to a predictive posture.
It's a pure hardware-enabled software-as-a-service model.
Exactly.
And the synergy here is incredibly clear when you look at Badger Meter's existing portfolio. A few years ago, Badger Meter acquired a U.S. company called SmartCover.
Right.
Which utilizes very similar technology and is a dominant player in the American wastewater monitoring market. So you take the undisputed U.S. leader, you acquire the undisputed UK leader, and you integrate them into a single global ecosystem.
They are combining both under what they brand as their Blue Edge suite of water management solutions.
Right.
By integrating the data architectures of SmartCover and UDlive, Badger Meter instantly establishes the premier global footprint in wastewater intelligence.
But the truly vital question is, why wastewater and why the massive focus on the UK market right now?
It comes down to regulatory catalysts and macro climate shifts. Extreme weather and climate variability are forcing utilities to really monitor stormwater.
Right.
And specifically in the United Kingdom, they are currently operating under a newly mandated infrastructure spending framework known as the AMP8 regulatory period.
And the UK water regulator is not messing around right now.
No. Ofwat has been levying massive, headline-grabbing fines against British water companies for dumping raw sewage into rivers and coastal waters during heavy rainfall.
Because their legacy combined sewer systems are fundamentally overwhelmed by the extreme weather and, increased urban density.
Exactly. OFWAT is no longer tolerating it. The AMT8 regulations legally mandate that these utilities deploy comprehensive, real-time monitoring across their entire wastewater networks.
So the UK government is essentially forcing municipalities to buy the exact predictive analytics that UDlive sells.
It's mandated spending. Utilities aren't buying these sensors because they want to upgrade their tech to look cool. They're buying them to avoid catastrophic regulatory fines.
And UDlive is perfectly positioned to capture a massive share of that guaranteed AMP8 capital allocation.
Because the UDlive model leans heavily on high-margin, recurring SaaS revenue, Badger Meter anticipates the acquisition will be accretive to their earnings per share within the first year.
It shifts their overall enterprise mix further away from purely transactional hardware sales and deeper into recurring software streams,
Which commands a higher valuation multiple from the market.
Strategically, the UDlive deal is a masterstroke. I mean, it captures mandated regulatory spending in a high-growth geography, but we have to look at the reality of the timing.
Yeah, dropping $100 million in cold cash during a quarter where your core organic revenue just fell 9% requires either immense financial confidence or sheer hubris.
Right, so let's examine their capital allocation strategy to see if they can actually afford to be this aggressive.
Well, the foundation of that aggression is a fortress balance sheet. Even after absorbing the revenue hit and the working capital drain of the $23 million Bismuth pre-buy, Badger Meter ended Q1 with over $205 million in cash and cash equivalents.
And absolutely zero debt.
Zero debt. That is huge.
It really is. Furthermore, despite the margin compression we talked about earlier, the underlying business model remains highly cash generative.
They produced nearly $30 million in free cash flow in the first quarter alone.
So the financial architecture of the company is rock solid, which allows them to execute these nine-figure cash acquisitions without stressing their liquidity ratios.
But they also took immediate defensive measures to protect that liquidity and protect margin integrity. When management realized the severity of the pacing gap, they didn't just rely on their cash pile.
No, they implemented a 10% executive salary reduction across the board for the next 6 months.
From a purely quantitative standpoint, a 10% cut to executive compensation for 6 months is statistically negligible against a $900 million annual revenue run rate. Oh, absolutely. It's not going to save the operating margins on its own. It's a drop in the bucket financially.
Right.
But we shouldn't dismiss the psychological signaling here. In modern corporate finance, executives rarely touch their own base compensation unless the situation is dire.
Yeah, it's a very symbolic gesture.
By taking that cut, management is broadcasting to institutional shareholders, hey, we recognize the severity of the miss, we are structurally disciplined, and we are feeling the pain alongside you.
It's an aggressive PR move designed to buy patience.
Exactly. But the real signal of management's internal conviction wasn't the salary cut.
No, it was their activity in the open market.
Yes.
During Q1, Badger Meter executed $38 million in share repurchases, retiring approximately 256,000 shares.
When a stock is down 24%, a Treasury Department basically has two options. If they believe the core business is fundamentally impaired, they hoard every dollar of cash to survive the winter.
But if they believe the market has violently mispriced a temporary operational hiccup, they deploy cash to buy back their own equity at a massive discount.
Dropping $38 million on buybacks is management screaming to the market that their internal valuation models show the stock is severely undervalued.
It proves they genuinely believe their own air pocket narrative. They are betting $38 million of shareholder capital that the second-half revenue recovery is real.
But, that internal confidence is completely meaningless if the future pipeline doesn't actually materialize.
Exactly. You can buy back all the stock you want, but if the purchase orders don't hit the income statement in Q3 and Q4, the stock will just continue to crater.
So let's open up the books and look at the exact growth catalysts they are relying on for this H2 recovery.
On the earnings call, management actually broke from their usual protocol and provided highly specific details about their forward pipeline just to calm the market down.
Yeah, they highlighted a subset of awarded, fully contracted AMI projects that are slated to begin heavy deployment in the second half of 2026.
And the sheer scale of this pipeline is what makes the bull case so compelling. This specific H2 cohort represents between 2.6 million and 3.6 million connections rolling out over the next few years.
To understand why management views Q1 as a temporary blip, you have to compare that new pipeline to their historical data.
Right. Let's look at the context.
Remember the massive 2023 to 2025 growth phase that created the original backlog?
The one that caused the pacing gap in the first place.
Exactly. That entire multi-year run of record revenues was driven by a cohort of roughly 800,000 connections.
Wait, only 800,000? So this incoming pipeline is more than triple the size of the project base that originally drove the stock to a 40 multiple.
Yes, more than triple. If they can execute on a 3.6 million connection funnel, the 9% drop in Q1 will be completely erased by an avalanche of new revenue.
And the undisputed crown jewel of that new funnel is the Prodesa project.
The Puerto Rico Aqueduct and Sewer Authority?
Right. This is a mammoth, island-wide infrastructure overhaul representing 1.6 million connections all on its own.
And the critical update from Q1 is that this is no longer just an awarded contract on paper.
Badger Meter officially received the first major multi-million-dollar purchase order for PRASA during the first quarter.
The hardware is being staged, and heavy physical deployment is scheduled to begin right around mid-year.
So the PRASA project is the primary engine of the projected second-half recovery.
It is, but this is exactly where we must address a massive, uncontrollable risk factor. Executive Vice President Bob Rockledge was very explicit about this on the call.
The weather caveat.
Yes. PRASA is a ground-level physical installation project occurring entirely on an island that is highly susceptible to extreme weather.
The Caribbean hurricane season.
Exactly. The percentage of completion accounting rules dictate that revenue recognition is directly tied to the actual physical installation of the meters.
So if the meters are just sitting in a warehouse in San Juan, they can't book the revenue.
Right. Management warned analysts that severe weather events could easily disrupt installation schedules. If a tropical storm hits Puerto Rico, the contractors stop working, the installations freeze, and Badger Meter cannot recognize the revenue.
So the entire second-half recovery, and essentially the stock's rebound, is resting on municipal execution speeds and the unpredictability of hurricane season.
That is the reality.
That feels like a very fragile foundation. You are buying the stock today. You aren't just betting on Badger Meter's technology. You are betting that the Atlantic hurricane season remains incredibly quiet.
It is the defining risk of the second half. The contracts are real, the demand is legally binding, but the timing of cash flows hitting the income statement is entirely at the mercy of ground-level realities.
Right. A Category 4 storm in September doesn't cancel the Price Act contract, but it pushes millions in revenue out into 2027, basically guaranteeing another massive earnings miss in Q3 or Q4.
Which brings us to the ultimate synthesis of this deep dive, weighing that massive pipeline against the structural risks.
Let's look at the final valuation and deliver the verdict. Before the earnings shock, Badger Meter was trading at a massive premium, roughly a 40 times PE ratio.
And the 24% plunge has violently compressed that multiple down to roughly 32 times forward earnings.
So we have a significant valuation reset here. A 32 multiple is still not traditionally cheap for an industrial hardware company, but for a high-margin tech transition story, it represents a completely different entry point than we've seen in years.
We have to synthesize the strategic outlook based on everything we've unpacked.
Let's clearly define the bull case first.
Okay. If you are buying the dip here, you believe this is a rare mispricing of a fundamentally elite business. You are getting a massive valuation reset on a certified dividend aristocrat with a pristine balance sheet.
Right, zero debt and $205 million in cash.
You believe the UDlive acquisition is a highly accretive masterstroke that will instantly capture mandated AMP8 spending in the UK.
And you credit management for brilliantly insulating gross margins with a $23 million Bismuth pre-buy.
And most importantly, you believe the air pocket theory is real, and the confirmed 3.6 million connection pipeline is about to hit and trigger massive revenue acceleration in the second half.
That is a strong path to recovery. But the bear case is equally structural.
The bears argue that the $15 to $20 million shortfall in short-cycle orders is not a coincidence. It is proof that short-cycle budgets might be structurally impaired due to the end of ARPA funding.
Furthermore, they see the $23 million Bismuth inventory not as a victory, but as a ticking time bomb.
Right, the cost lag hangover. Once that low-cost material is depleted, the new $34 a pound reality is waiting to crush late 2026 margins.
And finally, they argue that relying on flawless hurricane-free execution in Puerto Rico to hit guidance is a statistical gamble that a 32 multiple stock simply cannot afford to lose.
So, synthesizing all of that, the official strategic outlook rating for Badger-Meter based on the sources is volatile recovery potential.
The 24% haircut removed the price for perfection premium, but the company is now walking a tightrope.
The stock is not traditionally cheap, and the entire thesis rests on H2 execution. If PRISA deploys smoothly and short-cycle municipal orders stabilize, the stock will rebound aggressively.
But if municipal budget fatigue is real, or if weather delays the pipeline, the floor could easily drop again. It is a phenomenal case study in how quickly a perfectly smooth growth narrative can fracture when it collides with macroeconomic reality.
It really is.
And, it leaves you with a much broader, almost philosophical investment question about the nature of infrastructure today.
Absolutely.
We've spent all this time analyzing Badger-Meter's tactical defense against China's Bismuth export controls and their M&A pivot into high-tech UK radar sensors. But it forces you to wonder.
Yeah.
As global infrastructure becomes entirely digitized and smart, turning basic mechanical water pipes into interconnected grids running on predictive analytics, are we simply trading our old vulnerability of crumbling pipes for a new vulnerability to international tech and rare earth supply chains?
It's the ultimate paradox of efficiency. You gain unparalleled visibility into the network, but the hardware required to maintain that visibility introduces exponential geopolitical risk. Is a smart grid inherently more fragile?
A fascinating thought to leave on. We've upgraded the technology, but now the most basic resources on Earth can be held hostage by export controls on metals most people have never even heard of. Thank you for joining us on this deep dive. Risk defined. Portfolio protected.